Great. Well, hello, everyone. We're so glad you are here for a very important conversation about the impact of COVID-19 on the racial, gender, and generational wealth gaps. Today's webinar is hosted by the Social Policy Institute at Washington University in St. Louis and the Center for Household Financial Stability at the Federal Reserve Bank of St. Louis. My name is Pamela Chan, and I'm the Associate Director of the Social Policy Institute. To kick off, we want to know a little bit more about you. On your screens, I'm sending out a poll, there you go, asking you a couple of questions for us to see who's here. While you're doing that, I'll go ahead and give you an overview of what we've got on the agenda. We have a phenomenal panel today that's going to discuss the impacts of COVID-19 on the wealth gap. But first, we're going to be able to set the stage a little bit and give you some more background information. To do that, Ray Boshara, Director of the Center for Household Financial Stability at the Federal Reserve Bank of St. Louis, and Mikhail Grinstein-Weiss, the Director of the Social Policy Institute, will share results from each of our organizations' respective COVID-19 surveys. When Mikhail and Ray are done, we'll have some time to take a few questions from the audience before introducing our fantastic panel. All right, and if throughout the entire session, if you have questions, please feel free to submit them using the Q&A feature in Zoom. All right, I'm just going to give a few more seconds for folks to respond. It looks like we're very close to getting everyone's responses into the poll. All right. Well, I am so glad to see that we have lots of representation from folks around the country. Thank you all for joining today. And then so glad we also have people from different parts of sectors, from nonprofits, lots of nonprofits, lots of research and intermediate organizations, federal government, state and local governments, as well as others. Well, thank you all for joining today. Now, on to the event. It is my pleasure to introduce Ray Boshara, Director for Center for Household Stability at the Federal Reserve Bank in St. Louis.
Thank you, Pam. Thanks, McCall. Thanks, Sarah, and the fabulous team and our fabulous partners at the Social Policy Institute at WashU. This event is one among many that we envision doing together over the next months and years. So many of you might know that the Center for Household Financial Stability at the St. Louis Fed was established in 2013 in the wake of the Great Recession, really to focus on family wealth, what you save, what you own, less what you owe, your net worth. The view being that balance sheets matter, your wealth matters in ways that your income and your education and your job does not. And so we, and as many of you know who work in this field, wealth is unique, a unique construct for looking at these economic outcomes. When you have wealth, you have more stability, more resilience, and more upward economic mobility. So I have 5 slides today. 2 of them will be on wealth inequality before COVID-19, 2 slides on wealth inequality after COVID-19, and then 1 slide with a few concluding thoughts. So let's go to the first slide. All right, so what we're looking at here is what actually happened to the wealth pie since 1989 over the last 30 years. And as you can see, the top 10% has done quite well. Their share of the nation's wealth grew from 67% in 1989 to 77% in 2016. This is the most recent data the Fed has. For everybody else, the remaining 90% of the population, wealth has fallen. The wealth share has fallen. For those in the 50 to 90th percentile, so still pretty well off Americans, their wealth declined from 30 to 22%, while the bottom 50%, bottom half of the population, only had 3% in 1989, and it's declined all the way to 1% in 2016. And I would point out too that the share of Americans with negative net worth, their debts exceed their assets, has also grown in this time period from 7% to 1989 to 11% in 2016. So we have significant and growing wealth inequality in America. Next slide, please. Okay, what we're going to do here is kind of break down the overall wealth pie into sort of different demographic groups. And the three groups that we study at the Fed are education, age or generation, and race and ethnicity. We will be putting out a report on gender, and my colleague Anna will say a little bit more about that in her remarks. These these demographic drivers we find are more stable and more predictive and more useful in sort of thinking about what's driving the wealth gap, how do we understand it, and how do we address it. So let's start with education. The median net worth of somebody with not even a high school degree was $24,000, but at the very end, very top, somebody with a graduate degree or professional degree has a median net worth of $443,000. That's a gap of 18. This is the widest wealth gap that we have documented, and it's a huge driver of wealth inequality. Education isn't, we often think of education as a great equalizer. It's actually contributing a lot to wealth inequality, and especially to the racial wealth gap. Next, we're going to look at younger versus older. So younger Americans, the typical younger American, somebody under age 40, has about 18,000 in median net worth compared to somebody who's older, over age 60, 228,000 median net worth, a gap of about 12. Now, an important point here is that we're not just talking about a life cycle effect. Of course, younger Americans have less wealth than older Americans or earlier in their life. We're making a more fundamental and more disturbing point, which is that younger Americans today have significantly less wealth than younger Americans did a generation ago. All right. So we've documented this, and my colleague Anna will be saying a little bit more about that. And then the final demographic driver we look at is race and ethnicity. For purposes of today, I'm focusing just on the black-white gap. Median net worth for the typical African-American family is $16,000 compared to $163,000 for white, a gap of about 10. Now this gap, there's a range of ways to measure this. In our analysis, this gap has been fairly steady over 30 years, which in and of itself is very disturbing because we've had all kinds of other progress, including gains in education and income, political representation, but it's not translating into more wealth, all right? But the real thing that I want to draw your attention to here are these numbers highlighted in red. These are, we can talk about the gap, which we just did, but you can see that, with median wealth levels of 24,000, 18,000, and 16,000, that's not a lot of wealth. You think about, for example, with the black-white gap, what could you do with 16,000 versus what you could do with $163,000, okay? A lot less resilience, a lot less upward economic mobility. So I think it's just as important, if not more important, to focus on the actual levels of wealth that struggling families have, even though the gap itself is an important barometer of some other health measures of our economy and our society. Okay, let's move on to the next slide, please. This is my first slide looking at what's happened to wealth inequality after the pandemic broke out. Okay, I'd like to stress this is brand new data, and it's also very early in the pandemic and in the economic setback. So we're just getting a preview of what could be coming down the road. But what we do see here is that really three takeaways, I would say. First, if you look where that blue arrow is, you can see a small dip, and those really are wealth losses among the top 10% of the population, which are overwhelmingly changes in stock market value. And that isn't surprising, given that 83% of all stock market value is owned by the top 10%. So that's what you're really seeing there. But the thing I really want to point out, though, is even though there's been a small reduction at the top, as is typical in recessions, which are those pink bars there, the overall trend is increasing wealth at the very top. And then my final point, of course, is looking at, again, the bottom 90%, the green and the red lines. Once again, you're seeing wealth flatlining or decreasing. So in fact, as we have shown on the other slide, the wealth gap is in fact, has in fact been increasing pretty steadily over the last generation. Next slide, please. Okay, and so what I've done in this slide is take that little dip, that little, the blue arrow that I was showing you, and looking specifically at the last quarter that the Fed could measure, which was the end of December 2019 through the end of March 2020. What happened in Q1 of 2020? And so again, here are the actual numbers here. And you can, if you look at the top 10%, their wealth went from, I'm talking about what went from 5,635,91 to 5,191,327. So, surprisingly, the top 10% lost about 8% of its value, or about $445,000 per household. That's a significant drop, okay? But again, that largely reflects changes in the stock market, which, as many of you have known, the S&P 500 has rebounded a full 25%, since these data were recorded. So there's a lot of fluctuation at the very top. And then if you look at the bottom 50%, also a reduction, a little bit more modest, about 4.8%, about $1,000 on average for households in the bottom 50%. So the overall gap has actually been reduced about 3%, which that's encouraging. At the same time, though, I would once again draw your attention to the fact that even when we cut the data this way, we're still seeing really low levels of wealth among the bottom half of the population, $21,000 to $22,000, which again really cuts into your resilience, your stability, and your ability to move up the economic ladder. Final slide, please. So this is just a little bit of a summary and some concluding thoughts, due primarily to fluctuations in the stock market. The overall wealth gap has in fact narrowed since COVID-19, at least through March 31st, though it is still early, and over the long term, the gap has increased significantly. Secondly, as I've shown, racial, generational, and educational gaps have persisted or have actually grown over the last few decades. And this partially reflects the very limited exposure that struggling Americans, how much exposure they have to the stock market. Third, as I've said, and this is a key point, we should be way more concerned about the actual levels of wealth among struggling Americans and less concerned about the gap, although the gaps do matter in other ways. But in terms of helping people move their lives forward, we really should focus on building up wealth at the bottom and less about the gap. And then finally, as the panel will say a little bit more about, health and labor market trends since COVID-19 suggests that the wealth of struggling Americans may be even further reduced, regardless of whether the gap shrinks or grows. I'll leave it at that, and I'm pleased to turn it over to my good friend and colleague, McCall.
Excellent. Thanks so much, Ray, for this great, opening remark and for kicking us off, and for the Federal Reserve for co-hosting this event. And thank you all so much for tuning in today. I look forward to engaging with all of you on this important discussion that is needed now more than ever. We should not expect that the coronavirus to discriminate based on factors such as individual race and economic status. But unfortunately, it is very clear that the pandemic is having a disproportionate impact on people who are at least likely to have the resources to fight it. Compared with white Americans, the coronavirus death rate is 3.6 times higher for Black Americans and 2.5 times higher for Hispanic Americans. To put this in perspective, if Black and Hispanic Americans had survived the COVID-19 at the same rate of white Americans, at least 14,400 Black Americans and 1,200 Hispanic Americans would still be alive today. Given that today's event is jointly hosted by the Federal Reserve here in St. Louis and the Social Policy Institute at Washington University, it is important for me to share how the coronavirus is affecting St. Louis. Looking at this map on this graph, we can see that the COVID-19 cases are concentrated in the north part of the city and county. This is almost exactly a mirrors map that's showing the concentration of African American population in the city and the concentration of poverty in the city. Unfortunately, these devastating statistics about the coronavirus cases do not even begin to capture the full picture of the disease impact on the day-to-day lives of people across the country. As a response, the Social Policy Institute launched a nationally representative and longitudinal survey to look at the impact of COVID-19 on social and economic factors. The survey included approximately 500 respondents from all 50 states. And today I'll present data that came from the first wave that were collected between April 27 and May 12. We will be collecting additional waves every 3 months over the next year. Our survey includes more than 200 questions ranging from topics such as assets and wealth, employment, and health practices. For today's presentation, I will focus on finding which are some of the key indicators of wealth, including financial and job security, housing, and access to healthcare. Losing a job is one of the worst financial shocks and life events a family can ever face. During COVID-19 pandemic, unemployment has reached historic highs with more than 40 million unemployment claims filed, which even exceed the unemployment levels during the Great Depression. Although job loss is affecting everyone, regardless of race and income, our data show that Hispanic and low-income individuals are being affected the most. Our data truly show how far-reaching the impact of job and income loss are. People who lost their job or income are facing extremely high level of hardship, ranging from difficulties paying rent and bills and foregoing medical care. We also find that people who lost their job and income are at a very high risk of becoming food insecure. Even more devastating is that nearly 40% of food insecure individuals have difficulty affording food for their children. So what else happens when you lose a job? It's become harder to afford rent and housing payment. Low-income households who already spend over half of their income on housing alone before the pandemic may be at greater risk of evictions. A main component of policy response, such as the CARE Act, was to protect some low-income households from being evicted, but our data indicate that this is not nearly enough. We find that low and moderate income Hispanic homeowners are at the greatest risk of facing evictions. And as you can see in this graph, nearly 15% of them were evicted in the past 3 months. Without proper support, this number may be even increase. Losing a job in the US doesn't just mean losing a salary, but it often means losing also health insurance. We have seen a spike in uninsurance during the pandemic, and among those who become uninsured during the pandemic, 22% of whites, 16% of Blacks, and 17% of Hispanic individuals in our survey said that they become uninsured due to their job loss. Losing a health insurance is especially scary during a pandemic. 11% of all low and moderate income individuals from our survey were unable to receive medical care when needed, and 10% either postponed or could not fill a prescription for medication. And many indicated that they could not socially distance. But we know that social distance is one of the main recommendations to avoid getting the coronavirus. So we use our data to further investigate what predict the ability of our respondent to socially distance. And as you can see in this graph, we look on the relationship between race, liquid assets, which indicate how much money you have in the bank, and the ability of people to socially distance. The higher the number on the y-axis, the more difficult it is for a person to be able to afford social distancing. What you can see here is that regardless of race, the amount of liquid assets a household have is associated with being able to afford social distance. But as we know, and as Ray just presented, Black and Hispanic Americans are more likely to have lower levels of liquid assets. So during the corona pandemic, it is not just a story of people of all races being able to get ahead and pursue their dreams. It is also a question of allowing them to stay safe and survive. Thank you. And Ray and I are looking forward to taking some questions now.
Thank you both for helping to set the foundation for conversation. So we have a couple of questions that have come up for you. First, I think is directed to Ray first. How would you focus on actual wealth of Americans rather than the gaps? Can you elaborate more on this?
Sure. I think we have to encourage policymakers, nonprofits, and foundations to engage in activities that directly affect the balance sheets of struggling families. This would include tax time savings measures, increasing liquid savings, emergency savings, which McCall just pointed out are very important through the workplace or through games or through apps. Making sure, doing everything we can that when a home purchase is made, it actually increases in value. Making sure that when a family goes to college, that there's as few student loans as possible. Reducing debts if we can by easing the cost of living. There's a whole range of things that we can do. Strengthening safety nets. There's a range of things that we can do that would actually target very specific struggling families to build up their savings and their wealth and reduce their debts.
Great, thank you, Ray. So the next set of questions I'm going to direct to Michal. So Michal, there's some observations that you made about the rate of insurance, sorry, we just lost this. For Hispanic households, the impact of housing and evictions, is that correlated with citizen status? And are those that are undocumented less protected by policies like the eviction moratorium? And then as a second part of this is a lower rate of uninsurance due to job loss for Black and Hispanic households due to the fact that they had lower rates of insurance to start with.
So the question is if the higher rates of eviction is related to undocumented?
Yes.
This is a good question, and it's not something that we can tell with our survey because we didn't ask if people are undocumented, because that can be that might make survey respondent in unease to answer the survey and indicating undocumented. That's something that we might consider doing future waves. As I mentioned, we'll be in the field for every 3 months now during the next year. And the second question was about so can you repeat the second question? It's the health insurance.
Yes, if that was due to, if that was due to the fact that they had lower rates of insurance to start with.
Yeah, we're controlling for all of that. So in the analysis, we are controlling for lower level. And this, so some of it might be for it, but most of it is just the gaps in health insurance in the population.
Great. And then the last question I'll throw out to y'all right now is related to your observations of the St. Louis region. So what actions have the city or regional authorities taken to improve resiliency? And then how have things changed for folks and residents like Ferguson and other Black neighborhoods in the St. Louis area?
Okay.
Well, let me just say briefly, certainly the death of Michael Brown sparked conversations, commitments, commissions, funding that otherwise would not have happened. So we're talking and trying to free up resources and being more inclusive in our community development efforts in the region. Having said that, I don't think we are where we need to be and would like to be. I will say that, like around the country, the death of George Floyd has given those efforts new life, and there's a feeling that we really could do something this time. So there's commitment. It's very sincere. It's very real, and we're hoping that something meaningful will come forth of these efforts. So I'm pleased to see the commitments, but we do need to do more than we're doing.
And I will just add that I think the coronavirus pandemic just, what it does is stressing again this great need, because now it's not just these racial differences in job, in wealth, it's also this, devastating impact on the life of people, which is completely unacceptable. And I think that will also help to greater, movement and effort to really try to solve some of these systematic inequalities and inequities that have been here for years.
And if I can just add, thank you, McCall. I think that's right. People are talking about systems change like we haven't before. But I also think in these eras of big change and big disruption, whether it's the progressive era, the New Deal, the Great Depression, whenever we have large periods of inequality, it's typically followed by large opportunities for reform. And so I think we have an opportunity to think big, think creatively, to restore family wealth and hopefully do better on safety nets and a whole range of things that we haven't done very well on lately. It's a great opportunity to think big.
Yeah, and for those who are interested in learning more about that from Ray, he's a great book called The Next Progressive Era that you all can read. And for anyone that's looking for more information about the research, there are going to be some additional research deep dive presentations from the Social Policy Institute as well as the Center for Household Financial Security. So please stick around after the main event if you're interested in that. And then for those who have asked a lot of great questions around policy, I'm going to go ahead and move things to our panel because that's where they're going to be able to talk a little bit more about this. And I'm going to introduce our moderator. So I would like to introduce Erika Wright. Great, Erika, why don't you go ahead and come on, and the rest of the panel. Erika is Vice President of Global Philanthropy at the JP Morgan Chase Foundation, and she's here to moderate today. And we really welcome Erika back as a WashU alum, so we're glad to have her here today. Thank you.
Thanks, Pam, and good afternoon, everyone. I am so honored to be moderating a conversation with such a dynamic group of experts this afternoon, and really in such a critical time in our country. So joining us for the discussion, we have Dr. Darrick Hamilton, Executive Director of the Kirwan Institute for the Study of Race and Ethnicity at the Ohio State University. Next we have Dr. Ana Hernández-Kent, policy analyst for the Center for Household Financial Stability at the Federal Reserve Bank of St. Louis. And finally, we have Dr. Fenaba Addo. She is an associate professor of consumer science at the School of Human Ecology at the University of Wisconsin-Madison, and a visiting scholar with the Center for Household Financial Stability at the Federal Reserve Bank of St. Louis. So welcome, panelists. To start the discussion, I want to use just a few minutes to reflect a little bit on the data that was just shared. And turning first to Dr. Hamilton, there was kind of a broad picture painted of wealth inequality pre-COVID. And I'd love for you to speak a bit to the specific drivers around racial wealth inequality pre-COVID and what you anticipate, what you're seeing right now, but then what you anticipate to be the impact of COVID on these disparities moving forward.
So to think about the drivers of the racial wealth gap, I think we need to understand how wealth is generated in general. It is basically wealth that begets more wealth. We know that when Blacks acquire high levels of education, not only do they have less wealth than their white counterparts with high education, they often have less wealth than whites who have low levels of education. So income, education, they do not solve the racial wealth gap. If we really want to understand the origins of the racial wealth gap, we need to look to a history as well as a contemporary context in which Blacks have always been economically and politically vulnerable to a political economy that even when they were able to accumulate wealth, you know, we just had Juneteenth, we're about to have the anniversary of the Tulsa riots. Their accumulation has been subject to seizure because they have not been afforded the same protections as other groups. So really the story lies in the fact that wealth, more than any other economic indicator, is an inheritable precondition for Blacks as a result of a society that has not treated all lives equal. In terms of what we can expect going forward, you know, this recession's different. And I think some of the data has borne out that our two colleagues have presented before. This recession is going to be, at least initially, pervasive, period. We made a moral decision to shut down our economy in order to save lives, as opposed to previous recessions, which are often the result of some economic fundamentalism where we have speculation or overpriced assets, and then the market has an adjustment that leads us into a recession. So given that, we also still know that Blacks are generally first fired, last hired. So right now we have everybody was fired, sadly. We did have some public intervention, which was inadequate but useful when we sent out $1,200 checks, for example, which was at least providing some subsistence. And unfortunately, some of the uninsurance benefits are about to expire unless Congress acts. But nonetheless, with this pervasive despair on the entire economy, we know that as the country starts to reopen and we go back to work, one, there's not going to be enough jobs to employ all the people that were unemployed. And we know that it's going to be sorted based on race, so that Blacks will, unless we do something to act, it'll be a stylized fact that Blacks will be the last hired, regardless of education.
So I want to hold that point in the air so that we can talk about kind of what are the big opportunities and ideas around intervention. But first want to turn to Dr. Addo to talk about there's some complexity when we look at the intersectionality of different populations. And so I know your work really focuses on the intersection of race and gender. So I would love for you to talk a little bit about kind of key drivers of wealth inequality when you look at women, but then also women of color in particular. And what do you see COVID-19 doing in terms of either exacerbating or reducing those inequalities in that population?
Yes, thanks. Thanks for having me. So I actually want to start where Darrick kind of left off with talking about the unemployment, right? So We know that prior to the current pandemic and post-Great Recession, we did see a decline in pay inequities, gender pay inequities among women and men. However, there is still very much a gender wage gap that has been persistent. And we also know that there is occupational segregation and wage stagnation. So with occupational segregation, this is going to play into what we see happening when we had the stop in the economy back in March. Who was able to work from home or and continue to get paid, who was able to, or who was considered essential workers and had to risk their health and continue to work in order to earn a living, and those who were laid off, fired. And so when we start to dig deep into the occupational sectors that were classified essential versus non-essential and who could work and from home and earn a living, we see that women were disproportionately in jobs that that lost their jobs. So providing care work, teachers, education, and or part of this essential workforce, such as healthcare assistants that were had to risk their lives in order to continue to earn a living. I'll also say that we know that women are more likely to be primary caregivers, right, for both at the older ends for older adults, but also for young children. So when school closed, that made it difficult also for women who may not have lost their job, but to continue to work. So when we start to intersect this with race and ethnicity, we also know that Latina and Black women are much more likely to be primary breadwinners for their households or the sole income earners for their homes. And so if there was a pause in their income, if they were unable to work or earn a living, or if they had to risk their lives and go as an essential worker and be in that front line, they were maybe even more so bringing back this health risk into their households and into their families. So I know this panel is, we're going to be talking about wealth, and I've been focusing a lot on income, but when we think about as wealth scholars, we know that at the low ends of the income distribution, the correlation with wealth is pretty strong, but at the high ends of the wealth income distribution, it's not as strong. So people at the low ends, having a steady paycheck and earning a living is intimately tied with the fact that they have a little less of a private safety net, that wealth to draw upon at times like this, when they cannot earn that living. So I'll stop there for now.
Yeah, and we're going to come back to that point about income and wealth a little bit later. I want to turn to Dr. Kent to further kind of complicate this for the millennials. And so in your recent blog post, 3 Reasons Why Millennials May Face Devastating Setbacks from COVID-19, you noted some unique challenges faced by this group in particular, attempting to weather the pandemic. So can you talk about what the data says about the state of millennials facing COVID-19 and their financial health, and what do you see as kind of key challenges moving forward?
Sure. So just speaking for myself and not necessarily the Federal Reserve or the Federal Reserve System, we know that millennials were really unique from the other generations in that they've been hit now twice by pretty massive recessions early in their careers. And so at the beginning of the Great Recession, the oldest were just starting out, and so perhaps they were forced to take lower paying jobs or decided to go to college or go to graduate school, and thus took on more student debt. And we have seen from the data that their wealth building thus took a hit because of this. And even to the point where the latest data that we have in 2019, the end of 2019, they were still behind where older generations were at the same point in their lives at the same ages. And then of course, so they were already behind before, and I think this is a recurring theme that we're seeing with all of these different demographic breaks that we'll talk about today, is that many of these groups were vulnerable before. And so if you're vulnerable at the height during a boom, what's going to happen to you when you enter into a bust like we have with the COVID recession, and we've seen the same thing with millennials, that they've been hit hard, and they continue to be below where older generations have been.
So let's dig into the income wealth question a little bit further. We know there's been a lot of attention paid to unemployment being a significant impact from COVID-19. We know that that's critical in terms of thinking about people's financial stability. But in terms of weathering a shock or a crisis or a pandemic like we have right now, what role does wealth play? What's the difference in terms of how someone is able to weather a crisis of this magnitude and then not having wealth or a buffer?
Yeah, thank you for that question, Erika. So it's similar to what Ray said briefly in his remarks, and that wealth really over and above income, we found time and time again that it helps families weather financial shocks like the current one we're experiencing, and moreover, it helps people give them the ability to have economic mobility as well, to move up, so to speak, economically. And without that wealth, it's very, very difficult. So even with income, as Darrick and Fenaba have said, without wealth to help weather these shocks and to help move up, that can be very difficult. And it also has psychological effects too. So if people have wealth, they can feel like they have economic dignity in order to be able to make choices and be future focused, future oriented, as opposed to focused in on the present.
And I want to open it up to Darrick and Fenaba too, to just comment on that. When you're looking at your research and your data in the specific populations that you're studying, what is the meaning of wealth versus income in this space and in this moment?
Okay, I can go first. In addition to all that Ana has already outlined, I would say we also talk about wealth as a source of power and agency when we're thinking of where people's place in our society and the social structure within our society. So wealth gets you access to resources. And so at a time where resources are compromised, then, you know, that will it shifts power into and removes power from the most vulnerable population. So we talk about inequality, we talk about wealth gaps, because those who are the most vulnerable lack access to resources, which is access to power. So in particular, the work that I've looked at, and as I referenced earlier, we look at gender wealth gaps. Women are having to draw upon, you know, if they have wealth, it's less wealth than men. Black women and Latino women, even less wealth. So during these moments, during these times of economic crises, where are they drawing the resources from if they don't have them?
And I'm going to piggyback on both Fenaba and Ana and say that, you know, it's about power. It's about being able to make choices in your life. And that is what makes wealth different from income. And even when I said it is wealth that begets more wealth, the ways in which people accumulate wealth isn't really from income, savings out of income. Most Americans don't save and are pretty much living on their income, but it's having some down payment to put you in an asset that will passively appreciate and protect you over your life course. That's how many Americans generate wealth. And with COVID-19, we see vividly some of the vulnerabilities associated with not having wealth. So again, we're talking about jobs, we're talking about health, and we're talking about wealth. Well, if you didn't have wealth and you were an essential worker and you had a pre-existing condition, you pretty much had to go to work. You didn't have the agency in your life with liquidity, so you could say, I'm really not going to come in because I'm not going to put myself at risk. You got to go to work. You're vulnerable.
So I want to start transitioning our conversation into solutions a little bit, and we know that, and part of talking about solutions is identifying kind of all of the different problems and challenges. So I do want to ask just before we dive all the way in. We know about a lot of the kind of systemic inequities that have caused the racial wealth gaps and gender wealth gaps that we see today. I'm wondering if there is anything unique to COVID that we have not mentioned or touched on that you think will drive these wealth gaps even further. I think we've touched a little bit on health and who has been most impacted by COVID. And so I'm curious just if anyone has identified any, disparate impacts that are really potentially going to increase that racial wealth gap for populations.
So
and Dr. Hamilton, you start. Yeah, you start, you go.
There's an intersections of vulnerability. One is jobs, the other is health, another is education, and another is banking. And I'll try to be succinct and explain how they're interrelated and lead to a particular vulnerability with this recession. Clearly, jobs are an issue. We shut the economy down. There are in excess of 20 million people that are unemployed, and it's probably higher than that. So thinking that we could just turn a switch on and re-employ all those individuals, I think that's a misnomer. I think we have a Overton moment where we can do something dramatic. I'm in favor of a federal job guarantee. I don't think the private sector ever provides enough adequate quality jobs without fissuring, without leaving workers vulnerable with a whole lot of risk through gig employment so that they can adequately have enough employment. And then, by the way, with these federal jobs, we can make a more resilient infrastructure that could make us better prepared in terms of public health for the next pandemic or the next climate catastrophe that we know is going to come. So in terms of health, jobs are linked because we insure people through their jobs. We attach health insurance to jobs. So those 20 million people that may have had insurance that are now without employment, well, now they're vulnerable in terms of health insurance. So I'm also in favor of Medicare for all. I'm also in favor of single payer health insurance to make sure that vulnerability is a social vulnerability. And then in terms of banking, we saw that through federal interventions, those that had inadequate accounts, they probably still haven't received their check, that $1,200 check. And then businesses, if you were a Black business or Latinx business and you did not have an existing line of credit with a bank, and you probably would be the one that needed the most if you didn't have a line of credit, well, you're vulnerable. You didn't. So we need to ensure that there's adequate accounts for everybody, and the Fed can do that. And then I won't talk about capital because my colleagues want to jump in, I'm sure, but the last thing is education. And it relates to a lot of what both Fenaba and Ana have done in their work. Millennials, the other thing that happened to them, we told them to wait out the recession by going to college and acquiring massive levels of debt. We also know that the education industry in general right now is very vulnerable because of that shutdown over the last spring semester. So if we forgave debt, if we just had a debt forgiveness right now, we would do something generationally that would be justice, in my view, and it would be a stimulus to the education industry because they're vulnerable. And the last thing about the millennials is, however vulnerable they are as a total group, the disparities are worse when we look at race. So the education debt is dramatic. I did a paper with Chris Famagetti that shows that home ownership amongst millennials is as low as it's been generationally, dating all the way back to the greatest generation, and that the racial disparities in home ownership is higher for that demographic generationally compared to every other generation since we've been collecting home ownership. So basically an economic bill of rights in those domains is the policy solution.
Anna, do you want to build on that?
Well, Darrick, that was very well said. There's a lot to unpack there. You've hit on a lot of different points. I guess I'll just add that I think looking at education is very important, but something that people sometimes don't realize when we're talking about forgiveness of educational debt is that student loan debt is not the problem, it's a symptom of the larger problem. So the larger problem is that the cost of college has skyrocketed compared to the price of other goods over the past 30, 40 years. And that's something that people often don't realize. So even if you don't have to take out any debt, your parents, for example, pay your entire university, that's still drawing down their wealth, drawing down your wealth. And so I think the student loan crisis is obvious, it's out there, it's something that people can really put their finger on, but it's a symptom of the larger issue. The other part of that Darrick also touched on is that it's hitting different groups differently. And so the groups that are actually less able to pay off their student loan debt are more likely to default are actually those with much, much smaller balances, less than $10,000. Those are the groups that are really struggling. And so it may be that they took out the loan but weren't able to get the degree and thus don't have the degree to help them get a better job, better income, and pay down that loan. So I think there's a lot of different aspects that go into that issue. The other thing I'll just briefly mention that Fenaba might be a good segue into Fenaba's remarks is that one interesting data point that I found was for millennial moms and millennial dads, their unemployment rate was actually the same in February of this year. So it was 3.6%. But by April, for millennial moms, it was 14.2%, whereas for millennial dads, it was 10.5%. So they started out the same, but by the end, not the end, but one of the high points of unemployment rates, millennial moms were much, much higher in terms of unemployment than millennial dads. And as Fenaba said, women of color, Black and Latinx women are more likely to be primary or co-breadwinners of their household. So this is really having a disparate effect on families of color.
And Fenaba, I'm going to layer on just another piece to your answer. If you could also unpack a little bit the impact on single heads of household and women, single heads of household.
Sure. I guess what I want to start by saying, in line with what Darrick and Anna have already said, is that I think what makes this pandemic unique is that it's shedding a light on all the social programs and social policies that we're lacking in this society. And if we only had them, we would have been able to weather this, given the stop in the economy, and would not have exacerbated pre-existing inequalities. So as the education, unemployment, as well as thinking about paid family leave, thinking about affordable childcare, these are issues that people have been championing and talking about and trying to express the need for decades, for years, forever, right? And when something like this happens, which kind of did seem like something that we never thought probably some of us never thought was possible, it really highlighted the gaps in our society where social policy really could have played a strong role in trying to help the most vulnerable within our society. And so engulfed in that is, of course, single households or single parent households who, if we want to divide it up by labor market, essential versus non-essential, who had to go to work, who's going to watch their children, who is going to put their health at risk. Why don't we have supports within our society to help to assist families and different types of family structures within our society, right? So I think this pandemic has really shed a light on the need to think through better social and the institution of better social policies and where they were lacking. I'll also add that I think one of the concerns as we talk about this is we can't not talk about the uncertainty with regard to how long this is going to persist, right? So we get acts and the CARES Act, which put these temporary acts in place to help people for a couple of months, but we're really waiting on a vaccine that, according to the health experts, it isn't going to come for quite a while, right? So we're all on these like different timelines about when people are going to return or going to be able to start paying their debts, going to start being able to pay their bills, going to start being able to pay their student loans again. But it may not be the case that it aligns with when we can actually restart the economy. So I think that's important to raise about what this moment that we're living in is the uncertainty around when it will actually pass.
So I think you started to touch on kind of my last question around what policymakers should do. I'd love for you also to comment on what you think the private sector should do, philanthropy should be doing, and any other contributors around some of these wealth inequality issues. What changes or interventions would you recommend that will have a significant impact on closing these gaps?
Do you want me to start?
Yes, absolutely.
Okay. So one thing I think restoration of wealth gaps kind of presumes that people have wealth to start with. And I think we've highlighted today that a lot of people went into the pandemic without any, or with very little, or in debt. So we need to, first be aware that it may not be a rebuilding, but so much as how do we get people in a place where they can be financially stable to weather the next recession or pandemic. I think for women in particular, we continue to exploit their time and their labor without giving them the proper social policies and supports to weather times like this. And so really thinking about we have the experts, we have people, we have the researchers that have been studying this for years, for decades, about what we can do to help the most vulnerable in our society. And it's, it takes will to do that. That being said, maybe can I bunt this to Darrick about addressing what the private sector might be able to do? Because I think most of my answers focused on the need for federal and state and local government to step in.
Absolutely, Darrick.
What should the private sector do? Be good actors. But at the end of the day, I think part of the point is that the private sector is motivated by profit. We are in a moment now where they're getting pressure on them to be more just and inclusive, but we're going to need public power to rein in private power. I think the graphs that Ray started off with, showing such high concentrations at the top, that is plutocratic. They have too much economic power, in my view, and as a result of all that economic power, it translates into political power, which leads away from, which is anti-democratic. That as a result of having that economic power, they're able to capture the rules and structures so as to benefit their class. So, I'm all for social entrepreneurs who are interested in triple bottom lines, including doing good, but public power ultimately has to be the intervention to ensure that they do good. So philanthropy, what should they be doing? Philanthropy needs to be seeding big ideas. Philanthropy needs to know that, and Angela Glover Blackwell has made this point, that philanthropy should not be doing the role of government, but can facilitate government in understanding what innovative big ideas can demonstrate, so that they can bring it in and implement it. So, I'm for philanthropy to take risk, to really try to seed some of these big ideas. And then the last part about what we can do about wealth inequality in general, I'll mention three things. One is, again, I think we need a wealth tax because there's too much concentration at the top, irrespective of race, that class just has an obscene amount of power. And it's not a matter of me disliking them from having wealth. Have as much as you want. But the problem is they can use that wealth and translate it into stuff that's not good for all of us. The second thing is, I've talked a lot about baby bonds, and Fenaba alluded to capital as being a big issue. So I think we need to ensure that everybody has a capital endowment so that they can get into an asset that will passively appreciate over their life, like a debt-free education, like a home, or like a business with some capital. And you know what? I've said baby bonds and gotten some good credit for it, but at the end of the day, it's all about capital at a key point in your life. You don't have to do it for babies. You can do it at any point. but you can do it with down payments for a home. How do we ensure people get capital? Because the source of inequality is not savings. It's not active savings. It is capital by which you begin. The last thing, which might be more controversial, is reparations. And all of these things are necessary. Reparations, baby bonds. Reparations is a retrospective examination of the sordid history of the ways in which we have limited the capacities of Black individuals and their personhood when it comes to accumulating assets and free mobility throughout society. And then having redress after we do that acknowledgement and truth and reconciliation. That's the most direct and parsimonious way to address the racial wealth gap. And what it also does is it changes narratives about how we understand inequality. If we do that truth and reconciliation, we would know that inequality is grounded in resource deprivations, not some narrative about a welfare queen, a deadbeat dad, or a super predator. It's not individual deficits, it's resource deprivation. But reparations is a one-time thing, and that would be just, necessary, and help us get beyond our race problem and redefine poverty. But we need something in perpetuity that's prospective, like baby bonds, to offset the trend of capital accumulation and iteration so that everybody can have access to wealth.
So Anna, I want to hand it to you, and also at the same time start a little bit of the audience Q&A. So one of the audience questions was really around targeted student debt relief and forgiveness. And I wonder if you have thoughts and solutions for the public sector, the private sector, and beyond that might also touch on that point a bit.
Sure. So I think we want to make sure that if we're thinking about student debt forgiveness, we're targeting it in a way that doesn't exacerbate racial wealth inequality, because as we've already talked about, there are along racial lines differences in terms of the amount and how many people need to take out student loan debt. And so if we're just saying, let's forgive all student loan debt, personally, speaking for myself, I don't think that that's a great idea, because whites, for example, are more likely to have not only higher education, four-year college degrees, but also graduate degrees. And what some people don't know is that there are borrowing limits placed for undergraduates, but there are no borrowing limits for graduate or professional school. So a lot of times these really big numbers of student loan debt that you're seeing, that's for a borrower who's a graduate student or who went to law school or medical school. And presuming they finish their degree, their income should eventually help them be able to pay down those large amounts of debt. Whereas on the other hand, people that say went to a two-year college and got an associate's degree, they might have much smaller levels of debt at the median or on average, but they might struggle more to pay that off. So I think just going into this discussion with both eyes open and acknowledging that just blanket forgiveness might end up actually exacerbating the racial wealth gap.
So I think we have time for maybe one or two more audience questions, and I'm gonna take one that came in kind of in preparation for this panel discussion around geography, and whether or not you all see a potential difference in recovery and of certain populations based on kind of the economy of a place, and how a population might have an opportunity to recover or weather this pandemic better if they are in a more economically stable city. And I think people are thinking, what is the difference between being in a New York or a San Francisco versus where I am in a New Orleans? And what does an economy have to do with how these populations will weather these challenges?
Go ahead, Darrick. Yeah, go ahead. Sure.
But no, go Fen, sorry.
No, I'm processing the question because it's a great question. And so, I think, yes, we are thinking about the economy, but we're also thinking about the pandemic, right? And I think what we're seeing now, as we've started in the last few, days, seeing the number of cases started to go up again, and it's spreading into places that previously were not the hot areas for the crisis, that it's really showing the vulnerabilities of our society with regard to transmission of the pandemic, but also, it's not going to serve us to think that it's only going to happen in one place. So local economies, we knew at the early parts of the pandemic were preparing themselves and getting ready in the event that it did hit, but we cannot at all, begin to think about how should I say this? We cannot think about restoring the economy until we have a handle on the crisis. And so that's what my initial thoughts are. Maybe I can think of more things, but I think it's hard because I think, and I'm not sure who asked the question, but we did see this geographic sorting or segregation of the pandemic at first, but I think current stats are showing us that was probably a little too primary in thinking about it. So.
Yeah, the South has been particularly hard hit in the last
Florida,
couple of weeks.
Texas, in particular, North Carolina. Yeah. So places that who weathered the first few months of this with pretty low rates, but now it's spiking up. And so very different economies than where we saw the initial high rates of COVID diagnoses and death, but also thinking about that. I don't know. Anna? Darrick?
Darrick, Anna, would you like to take us home?
So geography matters. Geography is endogenous, though. It's not non-random, and one's race relates to where you end up living. So we need to understand that. And then, for those that are anti-segregation, that are integrationists, we also need to know that integration into hostility is not the solution either. That there's no guarantee that if a Black person is in a resource-rich area, that they have access to the resources. So we certainly need to consider that. Last thing I'll say about education also, I'm all for, to me, it's a moral issue. To me, people should have a pathway towards a college degree without debt and without having to fight. So I'm all for public colleges and universities and a one-time amnesty for all the people with a debt. And I should point out that the average debt for Black college graduates is in excess of $50,000. It's about $54,000 a year, which is about, in comparison to whites, about $30,000. So there's mixed results as to whether it closes the racial wealth gap or not. I think there's studies on both sides, but my point is it's a moral issue. So from a moral standpoint, if you want a moral economy, people should have a right to education, in my view. Muted.
Yeah.
I'm sorry, I was muted. Anna, we have about 30 seconds. Do you have final thoughts as we close out?
Sure. I just want to highlight that everything we've been talking about today, all these different demographic breaks, particularly race and ethnicity, it's not about individual choices, and it's not about individual factors in terms of, say, saving. Millennials save at higher rates than older generations did at similar ages. There's research to suggest that Blacks also save at higher rates than whites, controlling for other factors. And so it's not about individual choices. It's sometimes easy to assume, if you're part of an advantaged group, that opportunities are the same. And it just ignores a lot of structural issues that we've covered today, and what Darrick has said, how wealth begets wealth. So I just wanted to highlight that point before we close out.
Thank you for doing that. And thank you all for a really rich set of recommendations. I think the big ideas came out. So I am going to turn it back over to McCall, and thank you again for letting me moderate this conversation. It's a pleasure.
Thank you, Erika, so much for moderating this really, really important discussion. And thank you so much again for our incredible panelists, Darrick, Ana, and Fenaba. I also want to thank Ray and the Federal Reserve Bank for St. Louis for being such a great partner for today's event. And we're really fortunate to have such an incredible, talented wealth expert here with us today that not only help us understand the problem, but also offered some real solution for all of us to think about. It is clear we have much work ahead of us. And I hope this event encourage all of us to take what we have heard and think about how can we create some change to address these unacceptable wealth disparities that have been brought to light even more now during the coronavirus. Our panelists mentioned we need power. We need to empower our people to build wealth during and beyond the pandemic. And I hope the event today help us continue to build this momentum to support policies that increase wealth and individuals' level of powers regardless of people's gender, race, and income. I want to thank you, all of you, to taking the time to engage with us and being here today. And I'll pass it to Pam. Pam, we can hear you.
Thank you. Well, thank you, Michal, and everyone who was on panel today. This was a really rich discussion. I really appreciate all the expertise and ideas that were discussed today. And before you go, I would like to invite you to let us know about your experience in today's event. You'll see in the chat box a link there to answer 3 questions for an event evaluation in the chat box. And we know there's so much more to discuss. After this event, we'll be sending out a recording of the webinar along with some supporting materials that were mentioned today. If it can't wait and you wanna hear more, you're definitely in luck. In 5 minutes, we'll just take a quick break, and then the Social Policy Institute and the Center for Household Financial Stability will present more results from our respective surveys. So these presentations will last no more than 30 minutes total, and will cover topics such as the impact of COVID-19 on gig workers, households, and household wealth. We'll also be able to take more of your questions. Hello, everyone. Thank you. Thank you so much for staying and joining us to dive into the research that was shared by Ray and Michal earlier today. In the main event. So we're very excited to have some short presentations given to you by researchers from the Social Policy Institute, as well as the Center for Household Financial Stability at the Federal Reserve Bank of St. Louis. We're gonna start with Sam Buffy, who is a data analyst at the Social Policy Institute, and he is going to be sharing about the impact of COVID-19 on gig workers. So I will pass it to Sam. Great. So, Sam, once you have your screen on, can you start your video?
I can, just a second.
Okay. Thank you.
All right.
See
Can you see my screen?
Welcome. Yeah, you're good. I'm gonna take myself off, so enjoy your presentation.
Okay, well, I guess we should probably start at the beginning. So, okay, good afternoon, everyone. My name is Sam Buffy. I'm a data analyst at the Social Policy Institute here at WashU. And today we'll be talking about some research that we have been doing. This is using the same data set that Michal spoke about already. So this is a survey of adults in the United States. And we're gonna be looking at how gig economy workers have been faring during the COVID-19 pandemic. So to start, I just want to begin with a really high level overview of what's been happening to the labor market over the last 3.5 years or so. So generally unemployment has been fairly low and quite stable over the last 3.5 years until quite recently when the COVID-19 pandemic began and we saw lots of shutdowns of businesses and industries trying to protect ourselves from the pandemic. So there was the shutdown and a huge increase in the unemployment rate. And so in this presentation today, we want to dive in and look specifically on what has been happening to workers in the gig economy. And so when I talk about the gig economy, I'm speaking specifically about the segment of the labor market where workers can use online apps and platforms to do a wide range of jobs through really short-term contracts. So you can think about something like an Uber driver gets a really short-term contract to drive someone from point A to point B. And Etsy workers will get these short-term contracts to sell different crafts or things that they make. Airbnb, you can have a contract for a short or I guess extended period staying at a place that the Airbnb owner owns. So we're looking at these types of workers. And we're going to focus on how they have been responding to the pandemic. And so in our survey of adults in the United States, we found that about 8% reported that they had earned some money through the gig economy in the 3 months prior to the pandemic. And looking at those people who had been gig workers prior to the pandemic, we found that 1 in 3, slightly more than 1 in 3 actually, reported working less due to the COVID-19 pandemic. So I think that that's probably cause for concern to begin with, but when we start to dive down a little bit deeper to figure out who are these people who are working less due to the pandemic, we see that they had disproportionately low incomes in 2019. So this is before the pandemic ever even started. The people who are now working less due to the pandemic had lower incomes before the pandemic started. So we see people working less disproportionately came from these lower income groups, while those who are working more due to the pandemic actually tend to disproportionately pull from people in the higher income groups. And so that's, I think, a cause for concern. It suggests that the people who are working less had a lower level of baseline financial security, and so they're now working less despite starting at a more financially insecure point. We also asked gig workers how they would describe the income that they earn through the gig economy. So they could describe it as sort of a nice to have thing, but not essential for meeting day-to-day budgetary needs. They could also describe it as important, but non-essential, or just essential for meeting those basic budgetary needs. And a vast majority of respondents said that the income that they were earning through the gig economy was either important or essential for meeting their basic budgetary needs. When we kind of break this out by whether or not people are working more or less, while those working more, they did say that it was important or essential at higher rates, we do see that 86%, so a vast majority, 86% of those who are working less due to COVID-19 reported that that income that they're kind of missing out on was important or essential for meeting those basic household budgetary needs. And I think that that's another real cause for concern about what's happening to these frontline gig workers who disproportionately have low incomes to begin with. And now as they're working less, they're saying at very high rates that the income that they're missing out on was important or essential for meeting their basic budgetary needs. And I think that this suggests that many of them are probably at an acute risk of experiencing various household hardships, food insecurity, missed bill payments, missed rent payments. So I think that this is a real cause for concern for what's happening to these frontline gig workers. We did a little digging to try to tease out what may be driving some of these dynamics. And I certainly think that this is an area that we need to do more digging to sort of understand what exactly is happening. But one thing that I thought was worth sharing, and I think that this also touches on something that Ana was speaking of earlier in the panel discussion, we find that when we look at parents who are gig workers, men are disproportionately working more due to the pandemic, whereas women are disproportionately working less. And so that's some evidence here that maybe some of the household dynamics may be driving who is working more while, versus who is working less. And that's something to be aware of, though I suspect that there are other factors at play as well. So just wrapping up, we found that about 8% of our sample was earning money through the gig economy prior to the pandemic. And among those, 1 in 3 reported doing less gig work due to the COVID-19 pandemic. Among those who are working less, they had disproportionately low incomes before the pandemic even started. And those who are working less also report at very high rates that their gig incomes that they're missing out on are either important or essential for meeting their overall budgetary needs. We have some evidence suggesting that the household dynamics may be driving some of these trends, but we probably need to do more investigation to understand what exactly is driving some of this. We also had some evidence that suggested that maybe some of the industries that are disproportionately being affected by the pandemic tended to have workers who had lower baseline income. So that may be driving some of this as well. Just generally kind of connecting this back to the conversation we had earlier, this is a group of workers that I think is, there's certainly movements to organize these types of workers, but the structure of gig work can make it difficult, I think, to get this body to work together and to stay organized to advocate for their political needs. And so I think that it's going to take a big push to actually get the political powers to sort of enact these policy interventions to further support these gig workers who are at a really financially vulnerable position at this time. So that is my presentation. And I guess, Pam, do we want to do a few questions if there's time right now?
Yeah, thank you so much for that overview, Sam. We do have a question for you. How do we know what type of gig work is captured here? For example, Uber, Lyft versus Instacart.
Yeah, so we take our question in this survey, we borrow from the Shed. So it's a pretty wide, very inclusive type of question to include. So it would include Uber, Lyft, selling stuff online, renting out for Airbnb. So it's a very inclusive term, but we're restricting here to people who are doing that online. So they're using online platforms to facilitate that.
Great. And then another question for you is, does the survey ask whether the person joined the gig economy due to the pandemic?
I think that I don't want to commit to answering that specifically right now. I know that we ask questions. I think that we do ask that, but I'm not 100% sure. But I am happy to confirm or deny that when I get a chance to look at it. And then I can also, if you want to send me an email, I can send you a few details about that. My email, I'll just say, is sambuffy, so SAMBUFE @WUSTL.edu.
Great, thank you for that. And for anyone who wants to find that later, you can find it under our Social Policy Institute website under People. So Sam, I guess before we transition to Anna, do you have one thing you'd like to see happen in support of gig workers at this point?
Can you say that one more time, Pam?
What is there one thing you'd like to see done to support gig workers at this time?
Yeah, I mean, this may seem pretty straightforward, but we know that gig workers, this is something in our analysis that they had, it was really difficult for them, they said, to basically afford to social distance. It's there in order to keep income, it's, they have to give up social distancing. And I don't think that we have nearly the protections in place for gig workers that are needed. And I think that, frankly, this is a very straightforward answer sometimes, but just giving gig workers money, I think that cash infusions for gig workers would be really helpful to make them, give them the power basically to make the decision of if they want to take that risk or if they're being kind of financially pushed into taking that risk. So I think that, more kind of social distancing type protections for gig workers, as well as just the financial capability to not have to put themselves at risk would be the things that come to mind for me.
Well, thank you for that. And before you head off, one more question snuck in.
Sure.
So full-time workers are also gig workers, if you happen to know that.
So the gig workers can be, you could be doing a gig work full-time. Oftentimes, I don't think a lot of people realize this, a lot of the time gig workers are actually supplementing their incomes through gig work. So it's like you'll have kind of a either a part-time or full-time job, and then you'll kind of pick up extra hours doing gig work. And these analyses include anybody who's been doing gig work in the last 3 months.
Great. Well, thank you so much, Sam, for sharing that information as well as your perspective.
All right.
I'd like to welcome back Ana Hernández-Kent, from a policy analyst from the St. Louis Federal Reserve Bank. And Anna's going to talk more about the wealth inequality pre and post COVID. So I will pass it to you.
Great, thanks, Pam. Yeah, so I'm going to build on what Ray was saying. Hopefully everyone can see my screen. I have a split screen, so I just want to make sure. And so there we go. One of the facts that Ray threw out there in the previous session was that wealth inequality has really grown. And we see that both when we look at the median and when we look at the averages. And so here, what you're seeing here is that the top 10% of wealth, households with the top 10% of wealth in the United States, they have about 77% of total household wealth, whereas the bottom 50%, the bottom half of Americans, have 1%. So I haven't had lunch yet, and so putting this into food terms, it would be as if we ordered a pizza for 10 people, and one person got almost 8 slices of pizza, and 5 people had to share basically a bite of pizza. That's the state of wealth inequality in America today. And so breaking this down demographically, because as we spoke of, when you do this, you also see great disparities. This is what you get: the Black, white, Hispanic, white, educational as well as generational gaps. And so these gaps for Blacks and Hispanics are actually a little bit closer than they are when you look at the median. These are looking at averages. And the reason I did that is because this is using the distributional financial accounts, which is a quarterly data set that was recently released by the Board of Governors, which gives us a look at aggregate wealth levels for different demographic groups. And what we did was we adjusted it for inflation and brought it down to adjusted for household size, meaning that we were able to look at averages. And so the Black, white gap and Hispanic white gaps are very large, as you can see here in this next slide. On the left, we have the average Black, white racial wealth gaps, and on the right, we have Hispanic white racial wealth gaps. And the R's are correlations. Basically, over time, are those gaps growing or are they shrinking? And what we see is for both of these groups, both of these types of gaps, they're actually growing. So wealth inequality between Blacks and whites and Hispanics and whites has grown over this 30-year time frame. Notwithstanding, something else that Ray talked about was the importance of actual wealth that people have. So not just the gaps, but overall. And what we see here is that Blacks and Hispanics have very, very little, on average, roughly 20 cents or so, compared to every dollar of white wealth. So these gaps are very large, and even though they have been increasing on average over this 30-year period, they're fairly stable, and it's disturbing considering all of the other improvements we've seen in terms of income gaps, for example, in terms of political representation, et cetera, for these groups. So it doesn't seem to be translating into wealth the same way. So that's very frustrating as a researcher and very disturbing as well. Here we have the educational wealth gaps. On the left, we see average inflation-adjusted wealth by education of the household head. And what we can see is that wealth for college, bachelor's educated households has really grown quite amazingly over the past few decades, compared to wealth for the other groups is more or less stable. And so what you get in terms of the wealth gaps between those with a college degree and those without is that those gaps have increased over time as well. All right, finally, I wanted to show average wealth gaps for generations. As Ray said, this isn't just a fact that older people tend to have more wealth than younger people because they've had a lifetime of earnings and wealth accumulation. It's not just about that. So here, the bars, what I'm comparing is these generations at similar ages. So boomers at age 34, Gen Xers and millennials at age 32. And what we can see is that even at very similar ages, there are large wealth gaps where millennials had, and this is millennials in 2020, on average had about 42% less wealth than Gen Xers did at the same age. And then finally, because I know I'm pretty much out of time here, I wanted to hit on, even though we've talked about the importance of wealth as opposed to income or unemployment, I wanted to hit on the convergence of some of these different groups together in terms of job loss. So when the bars are positive, higher than the zero horizontal line, that means that those groups had greater job loss than would have been proportional to their share of the labor force. And if they were below the horizontal zero line, that means that they were basically buffered or protected from some of the job loss. So what really stands out to me here is that individuals with a bachelor's degree or higher are protected both in March and in April. And that's consistent with a lot of what we see in the data, suggesting that people with a higher educational degree have been those who are able to work from home and thus been more buffered from job loss. And I think that's it, but I'm happy to take questions.
Yes, well, thank you so much. I'm actually going to pull in a question that came up earlier, and it was about other demographic groups or other underrepresented groups, if you guys had a chance to explore that, such as Asian Pacific Islander populations or LGBTQ groups. If you've had any of that analysis, it'd be helpful to hear about it.
Yeah, that's a great question. So unfortunately, the data that we use at the Federal Reserve from the Board of Governors rolls up these groups, other races, other ethnicities, into this, quote, other category. So it really does a disservice to those groups in terms of understanding their financial position. But part of the reason is just that they're so small that we would be able to potentially identify those individuals who give very, very detailed information about their financial lives. So we don't want to do that, and so those are just rolled up into one category. There are other data sets that we don't use that are able to look at that a little bit more in depth. And the SHED, which Sam actually mentioned, Survey of Household Economics and Decision Making, they recently added a question on LGBTQ identity, and so I haven't looked into that yet. That was very recent, but it's something that we have the potential to look at in the future.
Sure. So then another question we had, I'm going to interpret it a little bit, but there was someone who noticed that there was an article on income inequality in the US increases most among Asians from 1970 to 2016. So they're asking to comment on it, and I'm guessing that that probably is talking about like what, does this have any implications on wealth, since that's what you're talking about.
Okay, yeah, I'm looking at the question now. I'm not familiar with that, that article, income inequality increased most among Asians, meaning Asians relative to whites. I'm sorry, I'm not familiar with that article. I know, I'm trying to think. So part of the issue is that even though Asians very likely make up a great majority of that other category, they're still not broken out. And so it's a little bit difficult to see that. I think generally speaking, income for Asian groups using other data sets seems to have surpassed that of whites, but wealth still in recent years, but wealth is still below. So again, pointing to the differences between income and wealth, you can't just only save yourself into higher wealth.
Yeah, and then the final question is a very interesting one. So it's about, why has middle-mass America not revolted against such gross wealth disparity?
I think part of the reason for that might just be that we are Americans and we have an American psyche. And so one of the things that we believe very strongly is this idea of an American dream, that if people are given equal opportunities, then it's up to them really at the individual level. They have agency in order to be able to succeed or not succeed. And there's a slew of research from various disciplines, sociology, psychology, economics, to back up this claim, this belief that people have. It's not necessarily fully grounded in reality, but I think psychologically it's something that we feel as Americans we should be able to succeed. And so people don't necessarily hate the idea of the wealthy, right? They might want to become that. So I think that's part of the reason that we don't see that. We don't have, as in say England, we don't have titles that are inherited in the United States. So it's not this overt inheritance, even though obviously a component of wealth in this country is largely inherited.
Yeah, and I think the second part of this question was actually about, like, is there ways to reduce inequality within capitalism? Since that's probably another part of our American narrative.
Yeah, I mean, lots of really great thought-provoking questions. I'd be interested to go in more depth with the person who's been saying that. I guess I'll just leave it at, you know, there's kind of this question that's being debated, like what's an optimal level of inequality, right? Because if we look at what people want in America, at least, people don't want perfect equality, right? We don't want everyone to have all exactly the same amount of wealth, and that goes back to this idea of American dream and equal opportunity, even though that's not necessarily the case. And so, but people don't want the amount of wealth inequality that we actually have, and they actually underestimate the amount of wealth inequality that we have. So they want some, but they don't want as much as we have. And so I think kind of reconciling those two and understanding the gaps is the first step towards helping those who are lower.
Well, thank you so much for sharing those thoughtful perspectives and opinions. So talking about the American dream, I'm going to go ahead and ask Yung Chun to come on up next. Thank you, Anna. So Yung is a senior data analyst at SPI, and he's actually be talking about homeowners and the negative impact of COVID-19 on U.S. homeowners. Welcome, Yung.
Thank you, Pam. Yes, my name is Yung Chun. I'm data analyst at Social Policy Institute. And the last presentation is about negative COVID-19 impacts on US homeowners. So let me start the last presentation with a paragraph from a Chinese novel in 1937. In his story, Lao Shi expressed that while the rain falls on the rich and the poor alike, rain is not just at all because it falls onto a world where there is no justice. I think our situation is not that much different from that in 100 years ago. Once we replace the rain into COVID-19, it exactly reflects current pandemic situation. Indeed, I view that the COVID-19 pandemic explicitly unveils structural problems that have been hidden or neglected so far. One of the crucial issue in the United States is housing inequality. Obviously, COVID-19 deteriorates the housing problems in the states. From the SPI's first wave COVID-19 survey, we found that 30.5% of respondents were forced to move by a bank, 7% were having difficulty keeping up their mortgage payment, and 8.2% skipped paying a utility bill or paid a bill late during the pandemic. These numbers are much greater than those in 2019. Again, this study explores the negative COVID-19 impact on homeowners in the United States. In particular, we explore whether the impacts were disproportionate depending on income and race and ethnicity. So our empirical model design. Obviously, our dependent variables are three housing-related hardship indicators, which are eviction, delinquency, and utility bill payment delay experienced in the past 3 months. Because these variables are binary, we conducted several probing models, and the two key independent variables are income and race. We also control for the employment status, homeownership, age, gender, marital status, and number of dependents, as well as state fixed effects. I plot the margins of the interaction term between the race and income. Here's the horizontal red lines represent the foreclosure rate and the delinquency rate in 2019 respectively. Our empirical model shows that in general, low and moderate income homeowners were more likely to experience eviction and delinquency than 2019. In particular, the COVID impacts on the delinquency and utility payment delay are substantial on non-Hispanic Black LMI homeowners. We also found that Hispanic LMI families are more likely to be evicted than LMI whites. However, because the eviction normally happens 3 to 4 months after the foreclosure filing, so the gap between the white and Hispanic may not be only associated with the pandemic impacts, but also relate to ongoing structural problems before the pandemic, such as immigration. But can we simplify that the color of skin solely explains the disproportionate impacts? Rather, we assume that so many mediator and moderator would exist on the line between race and housing hardship. As one of them, we assume that varying saving amount across LMI race group would explain the disproportionate impacts. As you see here, the average savings amount of LMI Black is significantly lower than that of LMI whites. If our assumption is valid, so that savings amount mediates the racial disproportionate COVID-19 impacts on housing hardships, then the varying impacts across the race group would disappear once we control for the savings amount. These two plots are results from the two profit models without and with saving amounts control. The left side is without saving amounts control and the right side is with the control. Regarding the risk of the delinquency, the difference becomes insignificant once we control for the savings amount, which indicate that the savings amount mediate the relationship between the race and the delinquency risk during the pandemic. Regarding the utility payment delay, we can say that the savings alleviate the disproportionate impact between white and Black because the difference becomes less significant once we control for the savings amount. To conclude, during the COVID-19 pandemic, many homeowners experienced housing-related hardship. The negative COVID-19 impacts on housing hardship are heterogeneous, and our empirical study reveals that financially and racially minor groups were more vulnerable than others. The pandemic unveils and resonates the structural problem of US society as it hits most vulnerable groups first. And the relatively small savings amount of the Black LMI population can be assumed as one of the structural problems. And we look forward to investigate such structural problems through the exploring the COVID-19 impacts based on the current and following SPI's COVID-19 surveys. Thank you.
Thank you so much, Jung. So I'm going to just ask you one question about in your housing expertise. What is something you would like to see to assist homeowners?
So as my result shows, I think savings matter because saving can be a buffer during the rainy days. So it is very important to encourage the people, especially low and moderate income households, to do more savings. But yeah, there are so many like policy remedies to encourage the savings, but I think the key part would be the savings or the like asset liquidity.
Great. Well, thank you so much, Jung, for the presentation and the data. I know that we're going to be coming out with more research as the team gets a chance to the COVID-19 survey more. I just want to say thank you so much for Sam and Anna and Jung for sharing their research insights. And I want to thank everyone in the audience for taking time out of your day today to spend with us to talk about COVID-19 and the impacts on wealth inequality. I hope everyone has a great afternoon. Thank you.